This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in Chapter 4, the first and probably most famous adjustment of profit that, again, we promise you'll remember till the day you leave this world, is the add back of depreciation. So what was happening? Depreciation charge could, of course, change from one year to another in line with whatever depreciation policy you wanted to use. So rather than HMRC allowing business taxpayers to just mix and match the depreciation policies to suit the amount of profits that they were making each year, what they did was to say, no, we're not going to leave it to you, the taxpayer, to decide what tax relief you will get in relation to the capital expenditure that you incur. And what we'll discover in a moment's time here in Chapter 5 is on qualifying plant and machinery. Instead, all of you are going to do it our way. Not random and individual depreciation policies, straight line, reducing balance, this percentage, that percentage, no. You'll all do it our way, the system of capital allowances. So what have we got? Capital allowances, as we've just said, replace the disallowed depreciation charge that we've just seen in the adjustment of profits there. They represent the way that everyone will be entitled to get tax relief against their trading profits in respect of expenditure incurred on the cost of qualifying plant and machinery. Again, an important statement to make it down here, but it really is important to understand from the outset that capital allowances are not simply available on all capital expenditure. Capital expenditure does not equal capital allowances. What equals capital allowances is qualifying capital expenditure on what we'll call qualifying plant and machinery. So here, but only on qualifying plant and machinery as stated above. Now, what is that qualifying plant and machinery? So here, plant is generally defined as assets that perform an active function in the business. They're doing something. Something with which the trade is carried on. Something with which the trade is carried on. And will include even things like office furniture and equipment, movable office partitioning. So plant and machinery is going to be a very wide and all-consuming term. You think about plant and machinery, you probably think, and rightly so, well, an industrial setup, a factory there, with items of plants and machinery that are used there to produce the goods that they manufacture. But it's wider than that. In the office, there will be fixtures and furnishings there, desks, chairs, there will be cupboards, etc. Fixtures and furnishings, those two will represent qualifying plant and machinery acquired for use within the trade. We'll also discover other things, as we have said. We will talk in terms there of, now notice that one, movable office partitioning as opposed to immovable. Reason why I put that one in, it's a well-known one. And sometimes you get objective testing questions that might say how many of the following or which of the following represent qualifying plant and machinery, or which one of the following does not represent qualifying plant and machinery, hence that one. Now we've defined there plant, machinery will include motor vehicles and computers. So yes, motor vehicles, vans, lorries, trucks, cars. Cars I mentioned there with a degree of trepidation, because when it comes to computing capital allowances and preparing the capital allowance computation, you can really guarantee that in any exam question, cars are going to be there. Because cars are, that is in real life, the awkward ones there in terms of, on this occasion, which particular type and level of capital allowance will we be entitled to claim. So cars are going to cause us more trouble, more time to be spent studying here than probably anything else. But yes, motor vehicles, computers, and will include building alterations necessary for the installation of plant and machinery. If you've got some heavy item of fixed plant here, then again, there are likely to be alterations that you have to do to your factory, to your warehouse, to be able to install that. All of that represents a part of the qualifying expenditure. We do not get capital allowances on the cost of a building. Land and buildings are not plant and machinery, so they do not rank for capital allowance. You buy a factory for £10 million, you won't get any tax relief into the cost of the land and the buildings there. Capital allowances here are only available for qualifying plant and machinery. But in, I say more recent times, probably a long time ago for you, but in more recent times to me anyway, they have actually allowed us to get more capital allowances in relation to the content of a building. So what we have here, they are available on, there's a word, integral features of a building used in the trade. And that will include such things as lifts and escalators, the electrical systems that you install, heating, and not that we normally need it in this country, an air cooling system there. So those have been specifically picked out and said, yeah, you can treat those as plant and machinery, and therefore they will attract capital allowances. But the actual cost of the land, of the building itself, these are costs that will not attract capital allowances. One that often confuses students, because, hence why I'm making the point now, students think capital allowances equals capital expenditure. No. Capital expenditure will be made up of the stuff we're talking about now, qualifying plant and machinery, but also capital expenditure like you buy a building, you buy land for use within the trade, where no, they will not rank, not qualify for capital allowances there. Again, as we said here, only on qualifying plant and machinery as stated above. For example, as stated above, the cost of a property purchased for use within the trade is capital expenditure, but only the cost of the integral features of that building will qualify for capital allowances. Okay. Now, in terms of the costs that you incur on an item of plant and machinery bought for use within the trade, having established that it is qualifying plant and machinery, what is the cost figure that will attract capital allowances? A couple of issues here. If, as is probably the case, a business is VAT registered, and the input VAT, as is usually the case, is recoverable on the purchase of an asset, then the VAT exclusive net cost will be available for capital allowances. Now, I know as yet we haven't studied VAT, but again, many of you will be familiar with the VAT system in terms of your own domestic tax system, whether that's the UK or elsewhere in Europe. Others further in far-flung parts of the world, you might not have that, but you may have a sales tax. Now, what happens with VAT is when you buy either stock, goods, when you incur expense items, when you buy plant and machinery, if you're buying it from a VAT-registered trader, that trader is required to charge on top of their own price, the money that they will eventually get to keep out of the total sales proceeds. They also have to charge that sales tax, that VAT. For us now, and for quite a few years, it's been 20%. So instead of selling the item of plant and machinery for $10,000, the sales price they need to make the required level of profit on that sale, they have to charge a 20% VAT amount on top of that. So they send an invoice out for $10,000 plus 20% VAT, £12,000. So when I as a buyer buy that item of plant, I am paying $12,000. But if I myself, and traders usually are VAT registered traders, then what will happen is I will pay out £12,000 to the seller of that item of plant and machinery. But in terms of the expense that I incur, I will be able to get back from Her Majesty's Revenue and Customs the £2,000 of what we call input VAT that I've suffered on that purchase. Equally, of course, then, when I produce my own goods and I sell those goods, I, as a VAT registered trader, have to charge my 20% VAT on top of my sales price. Now, that VAT is not my money. On the sales that I make, the 20% VAT that is charged, that comes into me when I invoice the customer for those goods, I don't get to keep all of that. The VAT on my sales, I then have to pay over on a regular basis to HMRC. But what I'm allowed to put against what we call the output tax on the sales that I have made is the input tax that I've suffered on costs that I have incurred. Now, most costs would be things like buying your materials and incurring expenses. But another cost now that we incur is on plant and machinery. And if you get to recover that input VAT, as most traders would do on normal qualifying plant and machinery, then what will happen is I buy it for £12,000, inclusive of £2,000 VAT. The £2,000 is recovered. I get that back against the VAT that I owe HMRC on my sales. I can offset my input tax on purchases against my output tax on sales. I pay HMRC the excess of that output tax over input tax. So what goes, and the point of this statement, what goes into your capital allowance computation to rank for capital allowances is not your gross cost of £12,000, but your net cost of £10,000. Now, having said that, applicable for most plant and machinery, I said to you about cars being our main problem when it comes to capital allowances. So, if the VAT is not recoverable, as for example, on the purchase of a car, or if it's a very small business and the business is not yet registered for VAT, then the VAT inclusive price will attract capital allowances. So if, for example, the asset that I was buying for use within my trade was a car that I paid £12,000 for, inclusive of £2,000 VAT when I bought this new car to be used within my trade there, then as I cannot recover input VAT on cars, I will be able to put the full £12,000 gross cost through the capital allowance computation. So an issue there about when we incur that cost, I'm paying £12,000 to the supplier for the purchase of this item of plant or machinery. What figure will I be able to take to the capital allowances computation? Routinely, it'll be the net £10,000, except when dealing with cars. When dealing with cars, it's the gross cost. Why? Because the input VAT is not recoverable. I cannot set that off against the output tax that I charge on my sales. There is your basic difference. Okay, so we have to identify in any list of expenditure of plant and machinery, capital expenditure, which of those items do and do not rank for capital allowances. When I've got the ones that do rank for capital allowances, qualifying plant and machinery, I then need to establish the allowable cost. Now, in most questions, they don't even reference VAT. Again, it will be excluded from the issue. And what you'll do is just pick up the given cost figure and put it into your capital allowances computation. If, however, they raise the issue of VAT, they give you either VAT inclusive or VAT exclusive figures, then you need to know that on most items of plant and machinery, if you are a VAT registered trader yourself, it is purely the net cost, in my example, the £10,000, that will go into the capital allowances computation. But if what I'm doing is buying a car and I am a VAT registered trader, then it is the £12,000, the gross cost, that will go into my capital allowances comp, because I won't be able to recover the £2,000 input VAT in my VAT returns, and therefore where I get tax relief is here now on the capital allowances computation. So having determined what qualifies and what cost is available, on my capital allowance computation, what will I be able to gain as the available capital allowance? First thing you've got to be able to do, though, is to know which expenditure will go to which capital allowance computation. For what period of time do I prepare a capital allowance computation? Now, when we looked at the adjustment of profit procedures in Chapter 4, what we saw was we'd start with an accounting profit, we'd disallow the non-allowable expenses like depreciation, we'd take away the sources of income credits to the statement of profit or loss that were not trading income, and get an adjusted profit. However, from that adjusted profit to derive the tax-adjusted trading profit for inclusion within an income tax computation, chargeable then to income tax as trading profit. What we had to do was to compute and deduct capital allowances, hence this chapter. So we need to understand that in the same way as we did our adjustment of profit for the accounting period of the business, so too do we now prepare the capital allowance computation for exactly the same, the accounting period of the business. So capital allowance computations will be prepared for the accounting period of the business, not the tax year. Now, if, as you will find in many exam situations, and therefore in many of the examples we're about to do, if the unincorporated trader, if the business prepares its accounts to the 5th of April, then the accounting period is indeed the same as, synonymous with, the tax year. But whatever is the accounting period, that is the period for which you prepare the capital allowance computation. So if the business prepares its accounts to a year ended 31st of December, then the capital allowance computation is for that. Or to 30th of June, 30th of September, 31st of March, whatever it might be. We prepare capital allowance comps for accounting periods, not income tax years. And as we've said, once you've got the figure, it'll then be deducted from the adjusted trading profit of that accounting period to give you the tax-adjusted trading profit. Now, what we're going to have to learn are the 3 types of capital allowance that may be available on this qualifying cost of the plant and machinery. In most businesses, it's very simple, and that is, it's just this one, that each year we get an annual, so as we'll see in a moment, this is based on a 12-month period, an annual investment allowance, which from now on we will know by the term AIA, a term you will use, of course, within your examination as well. Now, the AIA gives an allowance of 100% for the first £200,000 of qualifying expenditure incurred, and that, as we said, is based on a 12-month accounting period. 100% relief given on amounts of qualifying plant and machinery up to a total of £200,000. Now, most unincorporated trades are relatively smaller businesses, and they're not therefore going to be incurring at that level. But the examiner can do what he wants to, plus the same basic rules that we learn now for the unincorporated trader for capital allowances, just like with Chapter 4 for the adjustment of profit, are also used in corporation tax, where companies may be significantly bigger, and therefore their regular annual expenditure may very well be in excess of $200,000. But the first allowance that we give on the capital allowance computation is AIA. And if what we've got is normal items of qualifying plant and machinery for which the total for the accounting period, based on a 12-month period anyway, does not exceed $200,000, 100% of that expenditure will be available for tax relief and deducted from the adjusted profit in deriving the tax-adjusted trading profit. Now, I did keep saying for 12-month period. So if the accounting period of the business is other than 12 months, then the AIA will be time apportioned accordingly. For example, a business has prepared its accounts for a 9-month period would be entitled to an AIA of, well, obviously, 9/12 of 200. That, of course, is £150,000. The £200,000 limit applies in our exam, regardless of the period covered by the exam question. It has not always been £200,000, so we've had that figure now for a few years. It hasn't always been so. But whatever dates you are dealing with in terms of the accounting period or even accounting periods that they put into your question, you will take it as a £200,000 AIA, and that figure will be given to you on your rate and allowances page. So not one that you have to remember, but I think you probably will by the time you hit that examination room. Now then, qualifying plant and machinery. Now, I mentioned that the main problem as regards the qualifying plant and machinery was likely to be cars, motor cars indeed. So AIA is available on the purchase of all plant and machinery except motor cars. Notice that does not say motor vehicles, it very specifically says motor cars. That if you've got lorries, vans, trucks that you use to transport goods around there, equipment around, any such vans, lorries, trucks, they will attract your 100% AIA. It is only cars that we treat separately. And as you may guess it, cars, do you really need cars within the trade? Well, probably not. You do need plant and machinery. You do need delivery trucks there by which you can transport out to your customers the products that you have manufactured. These are things that you need. You don't really need to be supplying either the owners of the business or employees of that business with cars, for which of course sometimes there is some business use. So the tax treatment of cars is never as good as the tax treatment of other qualifying plant and machinery. And the first instance of this is we do not get AIA. Now then, what we do get, as we'll discover, is either writing down allowance, or sometimes, very good news, we might get the equivalent of 100% AIA, which is 100% first year allowance, a one-off allowable expenditure relief there. But again, that's going to be based on the CO2 emissions of the car. Again, the lower the CO2 emissions, the more eco-friendly the car is, then the better the tax relief. The dirtier the car is, then the less generous is the taxation system. Okay, we'll come to those later. So AIA, qualifying plant and machinery, but not cars. If, of course, we do have expenditure in excess of the AIA limit, the £200,000 a year, or on the majority of motor cars that we buy in any accounting period, then those, though not qualifying for AIA, will qualify for writing down allowance. So if I've spent £250,000 in my 12-month period on qualifying plant and machinery, then £200,000 is available for AIA, £50,000 is not. It will only be available for writing down allowance. We'll see over the page in a moment what that will attract. Or if I've also, on top of my £250,000, bought motor cars, then they too will not attract AIA, and probably what they will get will be writing down allowance. There's that one possibility, if they're very low CO2 emission cars, that I may get a much better allowance, 100% first year allowance. But we'll see that in a few minutes' time. Okay, over the page, therefore, to writing down allowance. Now, if you're a normal business, small business, you're not buying cars, you're buying plant and machinery for use within the trade, you never exceed £200,000, everything you buy in an accounting period will attract 100% relief. And that's it, job done. There's no more relief. Once you've got 100%, that's it. You don't get any more relief through the taxation system. So for most taxpayers, their capital allowance computation is incredibly simple. For any accounting period, we list out the qualifying plant and machinery, total it all up. I bought 10 items of plant in the year, totaling £120,000. What do I get? AIA 100%, £120,000 deduction as a capital allowance. And that's it, job done. And I do that accounting period by accounting period. That's a bit too easy for an exam question. So what's going to happen in the exam question is not all of the expenditure will be available for AIA for the two reasons that I've just given to you. Either because the total expenditure has gone above the AIA limit for the accounting period, and or we bought cars and there is no AIA available on cars. So then we look to see about WDA. What do we get? The cost of most plant and machinery that is not qualified for AIA will be allocated to a pool of expenditure. So if I've spent £250,000 in my 12-month period on plant and machinery, not cars, 200 of the 250,000 will attract 100% allowance. The remaining £50,000 I do not individually identify as individual assets and maintain a separate capital allowance computation for each asset. No, that would be ridiculous. What I do instead is look at my total 250,000, however many items of qualifying plant and machinery I may have bought, give 200,000 AIA and transfer the remaining 50,000 into a pool of all other qualifying plant and machinery that is not otherwise ranked for AIA. So allocated to a pool of expenditure that will then be eligible for a writing down allowance. Now again, these levels of allowance that we're about to see are given on your rates and allowances pages. But again, I think you'll remember them by the time you come to it. And they will be either 18% per annum, again this is an annual figure, if the expenditure qualifies for the main pool, which is the vast majority of, as we've called it, qualifying plant and machinery. Or 8% per annum if allocated to the special rate pool. Obviously, it's special in a bad way. Your main pool attracts 18% annual writing down allowance. Your special rate pool attracts only 8%. So special, but not in a good way here. What we would like is for all of our expenditure, if possible, that we have not been able to gain AIA upon, goes into the main pool, and then we'll be able to claim 18% annual writing down allowance. But if it's special rate expenditure that we've incurred here, stuff that goes to the special pool, we'll obviously have to learn which assets they are, then they are singled out, and in that special rate pool, they are only going to attract 8% per annum. This allowance is also available only on a reducing balance basis. So it's not straight line, it's reducing balance. So based on whatever expenditure has gone in, the amount of allowance each year that you get gets smaller and smaller and smaller, as the percentage figure that is applied, be it 18% or 8%, is on ever decreasing amounts. It's a reducing balance basis, therefore. And we'll see our later notes on which expenditure is indeed allocated to the main pool, which in reality is the vast majority of plant and machinery you buy, and which other expenditure is allocated to the special rate pool. As with AIA, the WDA, as we've said, it's an annual figure, will be time apportioned where the accounting period is other than 12 months. So it's 18% and 8% per annum. If our accounting period is other than 12 months, then we time apportion. The next one that, again, is the least common in reality and probably least common in exam questions is our first year allowance. A one-off, as we'll discover, 100% allowance. But it's very limited as regards what we get it on. And so far as our syllabus is concerned, it is only new cars, note not second-hand, new cars with CO2 emissions up to 50 grams per kilometre. They will attract this 100% first year allowance. The first year allowance itself is never time apportioned. So whereas if our accounting period was only 9 months instead of the full 12 months, AIA would be limited to 9/12 of the 200,000, i.e. 150,000, and our main pool WDA and special rate pool WDA, 18% and 8% respectively, are also time apportioned. We'll only get 9 months worth of those annual allowances of 18% or 8%. They are time apportioned. But the first year allowance is a one-off absolute allowance available, and it doesn't matter how long the accounting period is. If you've incurred that expenditure in the accounting period, whether it's 12 months, 9 months, 3 months, 15 months, whatever it is, it's a one-off allowance. Therefore, you get the full 100% first year allowance. It is never time apportioned. Okay, so you need to look carefully there again through the various allowances that are available to us, get our heads around the idea of the terminology, and then we'll have a little go at illustration 1. So just pause for the moment and then we'll work through that together. Okay, so let's do our first capital allowance computation here with illustration 1. We're told here, and something to watch out for very carefully in terms of an exam question, that we're not dealing with a normal continuing business and just a normal year end followed by a year end followed by a year end. What we got is that Richard commenced to trade on the 1st of July 17 and then prepares accounts to, here we see the chosen accounting date for Richard's business, the 31st of December, and logically we pick the next 31st of December 2017. So very important for us to identify that opening period. Remember, we produce the capital allowance computation for the accounting period, not the tax year. That opening accounting period from 1st of July 17 through to 31st of December 17 is just a 6-month period. Now that has important implications from what we've seen already. In terms of AIA, the level of AIA is £200,000, but it's an annual investment allowance. So that AIA needs to be time apportioned here downwards in terms of what is a short accounting period of only 6 months there. So we won't get the full £200,000 AIA, we'll get 6 months thereof. As also will be the case, if relevant, that in terms of a writing down allowance, main pool or special rate pool, as yet you do not know what is segregated out and put into that so-called special rate pool. So in this example, we'll only be dealing with, as is the case in the vast majority of plant and machinery bought, the main pool. But those allowances of 18% and 8% respectively on main pool and special rate pool, they're annual figures, 18% per annum. So again, if our accounting period as here is short, it's only 6 months, then we have to time apportion our WDA. We'll only get half a year's worth, 6 months worth. Now, the only time where you're going to see in any exam question that we face in this paper a period of an accounting period of other than 12 months is the opening period. Here we happen to have started trading on the 1st of July and chosen December. So we've gone with a 6-month period. You might, for example, have started to trade on 1st of July, picked 31st of December, but instead decided to do an 18-month period through to the 31st of December 18 as your long opening accounting period. Whatever it may be, that is the one and only time, given the restrictions of our syllabus, where we'll have to time apportion our AIA and then, respectively, the WDA. The reason being, businesses could change their accounting date with either a short or long period while continuing to trade. That is not within our syllabus. Change of accounting date is not within the Taxation UK syllabus. But you might also be thinking, well, okay, the opening period might not be 12 months. You don't start to trade, for example, here on the 1st of July and pick an accounting date that is exactly 12 months later, simply because that's when you started to trade. You'll select, for whatever reason you wish, your favoured choice of accounting date. So, in which case, therefore, you might be thinking, okay, we have a short period there, or we could have a long period. But In the same way as it's a problem when you start to trade, what about when you cease trading? You don't always cease trading on your normal accounting date. Should Richard ever cease to trade, he doesn't have to pick the 31st of December as the date, his normal accounting date, when he ceases to trade. It could be at any date at all. However, even though that final accounting period may be short or even maybe long period there, what we'll discover later in these notes is that in that final accounting period, we do not actually compute either an AIA or a WDA, and not as we've seen it yet, even the FYA. In that final accounting period, there'll be what we call balancing adjustments to compute to finish off, to finalise that capital allowance computation, because if that trade has ceased, then the capital allowances must cease with it. So there are balancing adjustments on the cessation of trading. And that is done in the final accounting period without any AIA, WDA or FYA applying. It's just, again, balancing adjustments. We see them later. So literally, the only time in terms of any exam question that you do that you're going to see a period of accounts of other than 12 months is the opening period. And that's what we've got here. When it is other than 12, remember, we're going to have to time apportion the £200,000 AIA and our 18%, or if relevant, 8% writing down allowances for the main pool and special rate pool. Had we bought, as we saw a few minutes ago, a low emission car, something as we saw here, low emission up to 50 grams per kilometre in terms of its CO2 emissions, then that would attract 100% FYA, and that was never time apportioned. I'll remind you again of that later. So here we go. Our opening 6-month period, so the accounting period to the 31st December 17, what we've got within that period, 2 purchases, plant and then some computer equipment. These are normal items of plant and machinery therefore, and those will both attract AIA. The problem is, as we know, is that that little total is £150,000. But the AIA available is only 6/12 of the £200,000 limit, which equals £100,000. So not all of that qualifying plant and machinery purchased during that accounting period will attract the AIA. Some of it will, to be precise, £100,000 of it will, and the balance, the residue, will then fall into the main pool. So what do we do before we move on to that second accounting period? Our capital allowance computations are prepared, as we said, for accounting periods. Here, this first one, the 6-month period through to the 31st of December 17. And always on these computations, the first expenditure that we deal with and list out on any capital allowance computation that we do is additions that rank for AIA. These are the first transactions we pick from the list of additions and possibly disposals indeed. Given within a question for an accounting period, we firstly list out the additions eligible for AIA. So we simply list out, based on the dates bought, the plant and the computers. As we've already said, and we show if this is a written question in section C, what our maximum AIA is. That, of course, here is only 100, so we restrict the allowance. Notice we've got a little working column here. We can put a name on that if we wish, and we'll see that later, but a little working column in which we record the additions of the period. And then we have a main pool, and always the far right-hand column is the allowances column, where we record the allowances available, claimable for this period. So that's, to begin with, £100,000 of AIA. So that puts 50,000, the residue, into the main pool. Again, only later will we discover that specific, or those specific items of plant and machinery that do not attract the main pool inclusion, but would go to a special rate pool. The only difference, of course, is that there it's a lower level of writing down allowance, WDA, as we'll know it from now on. But like with AIA, the WDA is also an annual figure, as we've said. So we'll only get 6 months worth of our 18% of what figure is available, £50,000. That should come out to £4,500. And that £4,500 then is what is transferred into our allowances column, giving us the total allowances of the period. And also importantly, because we're not just here dealing with one accounting period, but we've got to roll it on to the next period as well, we have got our tax written down value, TWDV, our tax written down value on our main pool to carry forward to the next accounting period. Remember, with these writing down allowances, they are on a reducing balance basis. So that carried forwards figure is 45,500, and next accounting period will only be available for a WDA. Again, remember, on a reducing balance basis. So look at what we've got. We have listed out for the accounting period, preparing the computation for the period, the additions of the period that rank for AIA. We then show our calculation where necessary, i.e. if the accounting period is other than 12 months, of a time apportioned figure of the annual 200,000. If, as here, the figure we determine is less than the qualifying expenditure, we limit our allowance to go into our allowances column to that figure here, 100,000. And the balance here, 50, goes into the main pool. What do we get? We get 18% writing down allowance on what is a main pool. But the period is only 6 months, so we take 6/12. Check the numbers on that, please, but I made that 4,500. 104,500 for the period. What do we do with it? Back in Chapter 4, we checked out how to work out an adjusted trading profit for an accounting period. Now we've got the capital allowances for the same accounting period. We deduct them from that adjusted profit to give us the tax-adjusted trading profit for the period overall. What we've also got, though, is the figure of tax written down value to carry forward to the next period. It's 45,500. So into that next accounting period, and this time it's a full year, full AIA, full WDA will be available. It's a 12-month period. So bring forward the tax written down value, always your starting point. And then, what did we say were the transactions that we deal with first? They are in fact the only transactions here. Look back to what we're told for this period. For this accounting year end, there's one transaction, a purchase on the 19th of May, machinery, £30,000. So we record in this working column. Now, again, you can just put a pound sign on there, but what you will see later on is we can call it AIA stroke FYA column. Because if you've got any expenditure like we have in these two periods, and I think like you always will have in any exam question, that ranks for AIA, you're going to list them out, all of these items, in this column. Later on, if it be necessary, the first year allowance will be the last of the allowances to be computed. But again, if you had any such low emission cars eligible for FYA, those would be dealt with finally. And again, you'd show them recorded in this little working column. So we can head it AIA stroke FYA, because that's the expenditure going into that column, or just put a pound sign and then just list the expenditure anyway. What do we have as expenditure? Additions of 30,000. Well, within our 200,000 AIA limit, so we get the whole 30,000 going into our allowances available column for the accounting period. Nothing to transfer into the pool. We have not exceeded the maximum limit of 200,000 for the period. So what do we claim our 18% WDA on? We claim it on that tax written down value brought forward. It's an 18% figure. Again, get your calculators out and make sure we got the right number on that, please. But 18%, deduct that as we have there in getting the tax written down value carried forward, but also show the allowance in the allowances available column, total with your AIA, and get the figure for the accounting period. Remember, where does that go? It goes to the adjustment of profit statement to be deducted from the adjusted trading profit to give you the tax adjusted trading profit. And that then, as we'll discover in Chapter 6, is the figure used in determining for any given tax year what trading profit adjusted for taxation will be assessed. How we relate an accounting period in which that profit has arisen to the tax year in which it will then be assessed, that's about bases of assessment. That's what we cover in Chapter 6. At the moment, it's about getting that tax adjusted trading profit. And to be able to do so, we need to be not only able to do an adjustment of profit, the pluses and minuses to the accounting profit, but in place of the disallowed depreciation charge, we need to compute these figures. What are the capital allowances of the accounting period? Take them away from the adjusted profit, get your tax adjusted trading profit there. Okay, so there's our first capital allowance computation. Review through, look back through what we've said about AIA and WDA and indeed FYA, and we'll get introduced to each of those further areas in way more detail as we progress through the series of lectures that we'll have here on Chapter 5.